Hello, welcome in this new video. I often get questions about risk management. I also get some responses on my book that the third part is about risk management primarily. Indeed, risk management is an often overlooked thing in trading. Everybody's focusing on the technical analysis part, and especially when you go online or on YouTube or Instagram or whatever, everybody seems to be focusing on being right or wrong. It doesn't matter if you're right on a trade or a setup. The before and after pictures, I told you so. It's not what trading is. Trading is looking at the market, identifying opportunity, and then managing risk. And with managing risk, that's what this video will be about. It's like you have a certain account size, and then you go into a trade, and the probability of that trade are that it will most likely turn out to be a trade that moves in the direction you anticipate. But it's also we can't look in the future, so you never know what happens on a certain chart or a certain trade. It's just it's all opportunity. So in this case, I want to start with this chart. As you can see, there are some charts on there. This is something I'm currently trading as well. So I'll leave it on for now. Doesn't matter too much what it is. The point is this move over here. I think it doesn't matter really what your strategy is. If price broke out of this range and started trending, you could have gotten into this trade on the first pullback. If it started rallying again and it came into a longer consolidation or pullback phase, maybe that's the moment you're ready to go. You know, it doesn't matter if you trade support or resistance or trend lines or whatever your strategy is. For some reason you think this is the moment for me to getting into a trade. So let's assume this back then broke out of this range, came back to retest, and then started rallying. So let's assume this would be a trade for you to be getting into. Then you would have been ready to take this trade around this place, this area, and then maybe you would have taken the trade up here or whatever. Doesn't really matter that much, but because you don't know in front until where it's gonna go, maybe you just remove your stop loss and you would have gotten out on the break of this level. Doesn't matter. So trading, this whole different story. Trading on moving your stop loss and riding the big waves, or just as a swing trader, you would have gotten into this trade and you would have assumed that the second move would be just as big as the first move was. Also a possibility to put your stop losses or whatever. So that being said, of course, every trade you take has to be something that has the potential to move in a certain direction, the direction you are taking the trade in. That needs to be bigger than the direction where a trade becomes invalid, because this would be invalid once it moves back into this channel. So this would have been a fake breakout. It moves back into the channel, then of course we want to be out of this trade. So let's assume that this would be the level you decide to exit the trade. Whatever reason you say the potential for this trade is the same as the move before the pullback, or whatever take profit rules you have, of course. The point is, it needs to be more than where your stop loss is. So in this case, we got a risk reward ratio of 4. So let's say you trade with a certain amount, 100 is your loss. So in this case 400 should be your profit potential. Okay, so keep that in mind. Take a look at this trade. I hope you get my point from a chart, from a technical analysis perspective. Now let me show you what I'm talking about when it comes to risk management. Yeah, so here is an Excel file. Some of you may recognize from a video I did last week. I got a lot of reaction and questions about it in a positive way. So let me point out again what I did over here. This is let's assume you start your capital. You start a trading career with 10,000 on your trading account. If you think, you know, if you're more like the 1000 guy or whatever, just scratch the zero, and you know, the picture is the same. Also, if you want to trade with a 100 account, sometimes that's the minimum deposit for a broker. It's a good thing to get started, but imagine that if you have a losing trade, you lose $2, and if you're a winning trade, you make 4, 6, or 8 or something like that. I don't know how that is with you. That does not motivate me to keep going, because as you can see, here it's 4. Then it stays like the 4%, and eventually, you know, after 20 trades, you make like $6. So you're trading for 3 or 4 months, and you make $6 a trade. So that's kind of the thing. There's also the question about how big should my trading capital be. I hope this clears that question as well. At the end of the day, it's up to you, of course. Never trade with money you can't lose, but you know, to start a serious trading career, it's kind of hard doing that with 100, but you get the picture. So here's the hypothetical capital you start with. Now here's the golden rule is, especially when you're a new trader, 1, but let's say 2% loss maximum on your account. That sounds less. That sounds like, you know, when you have the feeling your technical analysis is on point. Of course, you would start to make a 5% loss or some things like that. A lot of trading psychology comes into this when it comes to violating this rule. But assume that it is 5%. So if you have 1, 2, 3 losing trades, you're down 1,500 on 10,000. That's way too much. And if you want to get that back, maybe you increase your risk for getting it back. Revenge trading comes in, etc., etc. So that is definitely not something you should do. New traders, but also experienced traders. 2 experienced traders, maybe 3, but this is the maximum loss. If you don't believe me, you know, feel free to find out for yourself. But you know, it's what it is. Now, I just pointed out on the chart that if you're looking for a trading setup based on technical analysis, of course, never just jump into the market. You know where your trade becomes invalid, and that should be the point where 2% of your loss will take out the trade. So your position size can never be the same size, because it depends on where you get into the market. That is the position size is eventually that where you place your stop. That's where your entry is, and the distance between that should determine your lot size, because at the end of the day, if your stop loss gets hit, just 2% of your total trading account should be your loss. On the other hand, looking at profits, looking at probabilities, the other side of the story is that the 4% is twice as much as your loss. So let's assume you take on 5 trades. That's what I did in the first 2 columns, first 3 actually. As you can see, this was your start, and then let's assume you take your first trade. Let's say you take a loss, 200, and you take a win, and you know, clear that out. At the end of the trading week or trading period or whatever, yeah, sure, you took a loss. It's a part of trading. You took a winner as well, and the winner was bigger. So that way, you are up from the first, from your starting capital. This is just a profit. Doesn't matter if it's 400, 600, or 200. It's a profit, and you have protected your capital. Then again, same thing goes. I'm assuming you take a loss, but also you take a winner in a month, next month, and you are overall, you know, you cleaned out your loss. Your profit came in, of course, that cleaned up the part of your loss, and you're still up. So I combine these 3 with a starting capital, and I assume that every trading period or every move you take on a loss and a profit. Well, I hope you get the picture that eventually, after a couple of trades, you already made 50% profit. Well, you never know how much winners or losers you have. Also, another thing that could happen is that it is not a risk reward of 4%, but it's a risk reward of 6% or 8%. So your loss on that particular trade could have been 200, and in this case, if the trade keeps on moving and it reaches its potential, you have 600 or you have 800. So these moves, your losses will get bigger, your profits will get bigger, but let's say you have 10,000 and you really aim for the big winners. All you do is just go behind your charts every weekend, find the best setups you can find with the best potential, and just find the time, the space, and the mental capacity to just let them ride, and then the losing part becomes a lot more easy when a few of these big winners are in your trades for that, let's say, quarter or something. So I hope you get the picture a little bit. This is just the hypothetical, of course. You never know, maybe you take 2 losses and 1 win, then still you have protected your capital, of course. Maybe you take 1 loss and 1 winner, or then you have you're 6 up instead of 2. You know, play around with it a little bit, but make sure that you understand the fact that you have to cut your losses short. We all know the saying, and let those profits run high, because once in a good trade, just ride it out to the max. I personally do not trade lower than a 4-hour chart, and the reason for that is that it takes time. It does, but the charts are often clean, just like I showed on US dollar, Singapore dollar in the beginning of the video. But that's just the way I prefer to trade, and it takes time. So I put on a couple of things I didn't point out in the previous video, and that is time. I trade the bigger time frames, 4-hour, daily, weekly charts. That's the thing I'm looking at. If you are more of an action guy or action trader, of course it's up to you to to find a different strategy that works for you. Maybe intraday trading is something you do find a way to make money, and then these calculations can go up into a daily trading strategy. But time is of the essence, because you have to take the time to ride a certain wave or a certain price move. I put it just below time. That time frame, of course, is I already said it. If you trade the 4-hour daily and weekly chart, of course, that time frame takes more time for trades to be running. And if you trade the daily chart, of course you will find more trades probably, but believe me, your stop loss will get hit a lot. So that could be very stressful, and I do not like to sit behind my charts all day as well. So there are a lot of reasons I can go into on another video, but the time frame you pick will have effect on the time you need a trade to run. So let's say that some of my profits come in 2 months later. Finally, on 800, I'm happy. I didn't take a loss. I'm happy with my trade, with my 1-to-4 risk reward ratio, with 8%. So to me, it's what I prefer. And of course, your hit rate, like I said, on the lower time frames, your hit rate becomes lower as well. On the 4-hour time frames, things are a bit more clean. Takes more time, but your hit rate is a lot higher probably. Hit rate in the sense of taking on good trades that actually make your profit targets and don't get wiped out because of some news event or anything. And then finally, trading psychology. It's hard to take on a trade that's up to 500 and makes a pullback to 200, and then finally you say the structure is there. I'm staying into this trade. It'll turn around, and when it finally does, maybe it'll give you a second opportunity to add another swing trade within the situation, and eventually it moves up to your 1-to-4 risk reward ratio, and you're happy you stayed in. But that is a huge psychological part, and the same goes for the lower time frames. Taking a hit, 3 hits in the morning, and then looking for that winner in the evening. It's a tough game, because we simply, from trading psychology perspective, do not like to lose. But that's it for now. I hope this helps. I think it helps, because a lot of people are overlooking this part of trading. I'll see you in the next video. Thank you.